Meanwhile, in the UK, market participants kept a close watch on the latest political developments as the country heads for a fresh set of elections on December 12. While it's about Brexit, let's see how that is hitting the UK car industry. Well, Juliana, that's where we're going to begin our conversations this afternoon. Good afternoon, by the way.
Good afternoon, Chimmy.
All right, so the UK car industry says a hard Brexit could cut production by a third. What would that mean for the Society of Motor Manufacturers and Traders?
Well, what that would mean, Chimmy, is a fall in production by, as you said, a third, costing the UK car production industry about £40 billion. As you said, we've really been focusing on the election over the past couple of weeks, and there's been no discussion really about a hard Brexit. At the moment, we are due to leave the EU on the 31st of January. Car production sales have been falling 15% year on year in the UK, which really reflects a global trend, whereas consumers, are more happy to keep their cars for a couple of years rather than investing in new models. And the body are basically saying that if the UK are unable to facilitate a really good, ambitious trading relationship with the EU post-Brexit, then it's going to hit car production across the country more than any other industry. They predict that it will cost the UK about £3.4 billion a year. That's if we stick to the World Trade Organization tariffs. And this money will come from adding incentives to components that are coming outside of the EU. So very worrying. Of course, they're speaking to whoever is going to take over on December the 12th. And there seems to be a lot of work to be done. And it will only be a couple of weeks away until we're talking about the all-important Brexit terminology again.
Well, Juliana, I don't know how much you love going to the beach to have some fun. Travel retailer On the Beach says its profit dropped by 26% in the year to 30th September. How much damage has the Thomas Cook collapse caused in that sector?
Well, Chimmy, I do love going to the beach, by the way, especially at this time of the year. It's very cold in London. But, Thomas Cook, that fallout in September has really hit the aviation industry. And they're just slowly trying to come together and calculate all of the numbers. Gatwick, they recently estimate that this year alone, it cost them 600,000 passengers. And On the Beach, they are a package holiday company. Their profits have fallen by about £26 million. And that's because, like most of the affiliates here in the UK, they were offering lots of their customers Thomas Cook holidays. And that amounted to about 15% of On the Beach's business. They had to, of course, refund lots of customers. And they were involved in the repatriation of about 150,000 Brits. So even though they have shown this loss in profit, they believe that this is a one-off purchase. Their CEO was saying that the demise of Thomas Cook, who were their big rival, does amount to lots of possibilities in the future. And they did also say that following the collapse in September, they have seen a wave of customers coming into their sites booking holidays in the new year. So this time next year, they're hoping that that will be completely reversed.
Let's hope so. Let's hit the markets. What's the update at the moment?
Well, just as what Orich was saying there in Frankfurt, a lot of the markets are really putting all their sentiment on what's happening with China and the US. There hasn't been any action, but anything that Donald Trump mentions that's positive is pushing market sentiment up, and it's hit London. At intraday, the FTSE All-Share is up 0.44%, the FTSE 100 is up 0.47%, and the FTSE 250 is up 0.32%. In currencies, the British pound is up on the US dollar by 0.20%, up on the euro by 0.30%, and up on the Japanese yen by 0.26%, Chimmy.
Okay, Juliana, I think you should go have a good lunch. I'll see you tomorrow. Enjoy the day. And shares in Asia were mixed. today as investors looked for concrete developments on U.S.-China trade as the threat of increased tariffs looms. Mainland Chinese stocks shared gains from an earlier recovery to end their trading day lower, with the Shanghai Composite declining 0.13% and the Shenzhen Composite slipping 0.3%. The Hong Kong's Hang Seng Index closed 0.15%. The Nikkei 225 in Japan rose 0.28%, while the Topix Index gained 0.31%. South Korea's Kospi also advanced 0.31%. In the U.S., Dow futures dipped 3 points but indicated a positive open of more than 30 points. Futures on the S&P and Nasdaq were both marginally higher. Market focus is largely attuned to global trade developments after President Donald Trump said negotiators were close to reaching an initial trade deal. Washington and Beijing have imposed tariffs on billions of dollars worth of one another's goods since the start of 2018, battering financial markets and soaring business and consumer sentiment. And on global oil market, prices are lower today, reversing 2 days of gains after an industry report showing a surprise build in U.S. crude stockpiles. Brent crude futures dropped 15 cents to $64.12. Data from Industry Group, the American Petroleum Institute, late on Tuesday showed U.S. crude stocks rose by 3.6 million barrels last week to 449.6 million, compared with analysts' expectation for a decrease of 418,000 barrels. U.S. crude futures fell to $58.25 a barrel. And in metals market, gold prices were also lower today after U.S. President Donald Trump's comments that Washington was close to an interim trade deal with China boosted demand for riskier assets. Spot gold fell 0.1% to $1,459 per ounce. Prices touched a 2-week low of $1,450 in the previous session. U.S. gold futures shed 0.1% to $1,459. And away from those markets there, back here on the African continent, U.S. investment bank Goldman Sachs sees a future sizable moves in a near-term interest rate cut in Turkey, Russia, Mexico, Brazil, South Africa, and Egypt on the back of below potential growth and or subdued inflation. While in another report reported today, Goldman Sachs says cutting interest rates in Egypt would support long-term growth rates, but the government should cut the current interest rate by 200 to 400 basis points in 2020 to stimulate the private investment. The bank said in its report that the outlook for growth in Egypt is mixed, although the economy is growing by about 6% annually, but depends mainly on public investment in infrastructure projects. It predicts that a key role played by the tourism and oil sectors will continue to stimulate growth in the short term to offset weak consumption, private investment, and slow productivity growth. And Tanzania has received a $1 billion syndicated loan arranged by the Trade and Development Bank for infrastructure projects and is seeking an additional $500 million from the regional lender. The government said in 2016 it had agreed that a $7.6 billion loan from China's Export-Import Bank to build a railway line that will link it to neighbors, but the funds were never disbursed. East Africa's third biggest economy wants to profit from its long coastline and upgrade rickety railways and roads to serve growing economies in the wider East and Central Africa region. Okay, when we come back after this short break, we look into the latest development in South Africa. Just stay with us.